Okay, so this video is going to cover fair value adjustments and income tax effects. So the first thing we're going to look at is the fact that tax profit can be different to accounting profit. So there are three main reasons why this can happen. One is different depreciation rates. So for example, if for tax purposes you're depreciating a $100 asset over 4 years, you'd have a depreciation expense of $25. But for accounting purposes, you're depreciating it over 5 years, you have a depreciation expense of $20. So you can see as your expenses are different, then that will flow through and impact your profit. The second reason is there are differences in bad debts accounting. So for tax purposes, bad debts can only be expensed when they're actually written off. So when you recognize that you're not going to collect this expense, then that's for tax purpose, it can be written off. But for accounting purposes, what you do usually is you expense out your bad debts at, say, the start of the period, and you just create a liability for the provision for doubtful debts, saying that this is how many of the value of the debts that I don't think I'll collect. So it's more of an estimate. So the difference in expensing there will obviously impact the profit again. The third reason, differences in prepaid expenses. So if you were to pay for, say, $30,000 of prepaid rent on the 1st of December, for tax purposes, that entire $30,000 would be treated as an expense immediately, but for accounting purposes, you'd recognize a prepaid asset, and then you would expense out that asset as you actually used up the rent over the period of time. So because of the difference between tax profit and accounting profit, we often need to recognize deferred tax assets or deferred tax liabilities on our balance sheet. So a deferred tax asset is when the tax base of an asset is larger than the carrying value of an asset, or the tax base of a liability is less than the carrying value of a liability. So if we look at this first dot point here, another way to think about this is if the depreciation expense for tax purposes is less than the depreciation expense for accounting purposes, we'll get a deferred tax asset. This is because if for tax purposes the expense is less, you'll have more profit, and so you'll pay more tax than what your accounting numbers would suggest. Okay, so deferred tax liability, it's just the opposites of the deferred tax asset. So if the tax base of an asset is less than the carrying value of an asset, or the tax base of a liability is larger than the carrying value of a liability. So again, deferred tax liability, this first dot point, another way to think of it is if your depreciation expense for tax purposes is larger than your depreciation expense for accounting purposes, then you get a deferred tax liability. This is because for tax purposes, you'll have less profit, and you'll be paying less tax than what your accounting numbers suggest you should. I've got an example here just to illustrate what I've just spoken about. So Ben Limited purchased a machine for $100. So for tax purposes, useful life is 4 years. Accounting purposes, useful life is 5 years. So if revenue is constant at $100, right, for tax purposes, the depreciation expense will be $25 a year because it's 100 divided by 4, so we get 25. For accounting purposes, depreciation expense will be $20 a year because it's 100 divided by 5, so we get 20. So you can see for accounting purposes, our profit is $80. For tax purposes, it's $75. So our accounting tax expense is higher than our tax payable for tax purpose. So the tax payable is the amount that we will actually physically pay to the tax office. And because of this scenario, it becomes a deferred tax liability. Now, I'm going to explain why now. So you can see years 1 to 4, depreciation expense for tax purposes is $25 a year. For accounting purposes, it's $20 a year between years 1 to 4. So what happens that for every year from 1 to 4, the reduction in profit for tax purposes is $5. So that means that we'll be paying tax on $5 less profit every single year. So essentially, the amount of tax saved from this $5 is $1.50. So in year 1, 2, 3, and 4, we will pay $1.50 less tax every single year than what our accounting numbers suggest that we should pay. However, in year 5, you can see that for tax purposes, there will be no depreciation expense because the asset will be fully depreciated. So that means, but then accounting purposes, you can see there is a $20 depreciation expense. So that means for tax purposes, we'll have $20 more profit. So we'll have to pay tax on $20 more than what our accounting numbers suggest. So in year 5, we'll be paying $6 more tax than what accounting numbers suggest. In years 1 to 4, we paid a total of $6 less tax. So the reason this is a deferred tax liability is because between years 1 to 4, we were always liable to pay these $1.50 of tax each year, but we have simply deferred those amounts, which total $6, to the 5th year. Okay, so the way that we'd actually record this is obviously for accounting purposes, we'd have a tax expense of $24. So we debit our tax expense. Then we know that we will actually physically only have to pay $22.50 to the tax office. So we just record a credit to the tax payable for $20.50. And we know, as I suggested, that the deferred tax liability will be $1.50 per year. So we've got an expense of $24. We'll have total liabilities of $24. It's just most of it will be the tax payable, but the other little bit will be amount of tax that we've deferred until later. Okay, so now I'm going to talk about fair value adjustments. So these adjustments are required when the assets or liabilities of the company being acquired are not at fair value. So the fair value of an asset is the value that you can get in an arm's length transaction. So what this means is if I was to sell, say, an asset to an unrelated party, then the amount of money they would pay for that asset would be the fair value. So there's no mates rates or anything like that. It's what you'd actually get on the market. So a deferred tax asset arises when the fair value is less than the carrying amount, and a deferred tax liability arises when the fair value is larger than the carrying amount. So the reason this is, say, we'll consider deferred tax liability. If the fair value is larger than the carrying amount, then if you were to sell that asset, then the subsidiary would make a gain. Obviously, that gain would be taxed. And so because you haven't actually sold the asset, you don't have to pay the tax now, but it will be deferred to a later period when you actually do sell the asset. And then if you consider a deferred tax asset, this is when the fair value is less than the carrying amount. So effectively, if you were to sell this asset, then you would recognize a loss. So this would reduce your profit and you'd pay less tax. However, because you haven't actually sold this asset, you won't recognize any loss, and so you will pay tax as if there was actually no loss. So this means you'll be paying too much tax than what you should be. So you recognize a deferred tax asset because effectively you've paid an amount of tax to the tax office that you don't actually owe them. So they are liable to return that to you. So then you recognize an asset for tax that you will be able to use in the future when you actually sell this asset. Okay, so I've got an example for fair value adjustment. So Ben Limited acquires QCO for $1 million on 1 July 2015. QCO's equity is comprised of retained earnings of $600,000 and share capital of $200,000. All assets are at fair value except land and equipment, and the land is sold on 30 June 2017 for $400,000. The tax rate is 30%, So we need to record all consolidation entries. So the first thing we'll want to do is our acquisition analysis. So this is exactly the same as we've done in the previous video, except this time we need to calculate this business combination value reserve amount. So the way we do this is we take the fair value minus the carrying amount, then multiply it by 0.7. We do this because when we increase the value of our asset, the owners of the company would be entitled to more equity if the company was to sell that asset. So the BCVR is an after-tax amount, because if you were to sell the asset, the owners would obviously get the $150,000, say if we're using land as an example, but they'd have to pay 30% tax, and so they'd only get $105,000. So that's how much we increase the equity by. Same again for the equipment. See, the fair value is $200,000. If we take away the carrying amount, it's $100,000, so we get $100,000 multiplied by 0.7, so that's $70,000. Okay, so then our acquisition analysis as it was before. So we pay $1 million. We know it's less the BCVR that we just calculated of $175,000, less $600,000 of retained earnings, which is from the question, less $200,000 of share capital, again from the question, and the difference between the amount of money that we paid for the acquisition and that of the fair value of the assets comes out to be positive $25,000. So this is the amount of goodwill that we recognize. Okay, so first off, we need to eliminate the investment asset for our first consolidation entries. So the way we're going to do this, we're going to debit share capital as we would, because we need to eliminate all the equity, which we know was $200,000. We're going to debit retained earnings. Now, I explained in the previous video why we actually need to eliminate this equity. So it's a good video to watch if you don't understand why we're eliminating this. Then we debit the BCVR by $175,000. So I'll explain at the end of this video why we need to eliminate the BCVR. So we debit goodwill by $25,000, and then we credit our investment asset by $1 million. So we've eliminated all the equity because we paid $25,000 more than the actual net assets, which the fair value of the net assets, which is represented by the equity. We have to recognize that goodwill of $25,000. Okay, so now we're going to look at our consolidation entries to revalue land. So we know that the subsidiary has recognized land at a carrying amount of $200,000, but we know the fair value is $350,000. So to increase land to its fair value, obviously we need to debit land by $150,000 to take it from $200,000 to $350,000. Then we need to credit the BCVR by $105,000. Now, this is because what would happen if we were to sell this land? We'd make a gain of $150,000. So the owners of the company would be entitled to that gain, but they'd pay 30% tax on that gain. So the actual amount they'd receive in the end is only $105,000. So the tax is then represented by a deferred tax liability of $45,000 because we're effectively making a gain. We haven't actually realized the gain yet, so the tax will be deferred to a later period when we actually sell it. If the year of sale, the entries are slightly different. So we know that according to the question, the land is sold for $400,000 and the subsidiary recognizes the land at a carrying amount of $200,000. So we know that our subsidiary will recognize a gain on sale of $200,000. So they'll do this by crediting gain on sale. But we know that the group has recorded the land at cost of $350,000. So when we sell it for $400,000, we'll actually only have a gain of $50,000. So the way we're going to reduce the gain of the subsidiary, so they credited $200,000, so we're going to debit the gain on sale by $150,000 to bring the actual gain down to $50,000. We're then going to credit our BCVR of $105,000. All right, for the same reason, the owners are still attributable to that $105,000 increase in the value of equipment. And then we're going to credit income tax expense by $45,000 because that tax expense is no longer to be deferred to the future. We've sold the land now, so we have to pay the tax now. Okay, so the year after sale, the adjustments that we need to make are we need to debit retained earnings, the opening balance by $105,000 and credit BCVR by $105,000. Now the reason this is because in the year of sale, this reduction to the gain of sale that we made of $150,000 was offset by a reduction in the tax expense by $45,000. So what we did here was we reduced equity by $150,000, but here we increased equity by $45,000. But because both of these accounts have been closed to retained earnings in the year of sale, we know that going forward, we're always going to have to reduce equity by $105,000 because our subsidiary would have increased equity too much. So we're going to have to bring it back down. So we'll have to debit retained earnings, the opening balance, by $105,000 going forward. Now, the owners of the company will always be entitled to the $105,000 increase in equity of the equipment at the date of acquisition. So that's why we're crediting BCVR. Okay, so now we're going to move on to revaluing the equipment. So the first thing we need to do when revaluing equipment is we need to clear out any accumulated depreciation. The way we're going to do that, we're going to debit the accumulated depreciation. And we know in the question it tells us that the cost is $300,000 and the current carrying amount is $100,000. So we've obviously accumulated $200,000 of depreciation. So we will clear that out. And we will then just credit the equipment so that by the same $200,000 so that it's sitting on the balance sheet as if it hasn't been depreciated yet. So it would sit on the balance sheet $100,000 from this transaction, but we know that we've actually recognized fair value at $200,000. So we need to increase the value of the equipment to that $200,000. The way we'll do that is we'll debit equipment by $100,000. We will credit BCVR by $70,000. So that's the same reason as I said with the land. If we were to sell this equipment now, the owners of the company would receive an increase in equity of $100,000 minus the 30% tax they'd pay. So there'd be a $70,000 profit that the owners would receive. And so that's why we're crediting by $70,000. And obviously, they'd have to pay tax, as I've just said. So that would come in the form of deferred tax liability, which would turn into an expense in the year of sale. We know that the tax amount is equal to 30%, and so it's $30,000. So we also need to consider the amount of depreciation expense. Because the subsidiary only recognised the equipment at a carrying amount of $100,000, but the group recognises it at $200,000, the depreciation expense will be different. We know the useful life is 5 years because it tells us in the question, but for the subsidiary, if we divide the $100,000 by 5 years, we'll know they will expense $20,000 a year in depreciation. But if we divide the $200,000 that the group recognises as equipment at by 5 years, we know that the group will want to recognise $40,000. So the subsidiary will always recognise $20,000 every year in its books, but we need to recognise a total of $40,000. So we're going to have to record an increase in the depreciation expense every year of $20,000 so that we make sure we're depreciating a total of $40,000. So we'll debit the depreciation expense and we'll credit accumulated depreciation. But when we do this, we will also have an impact on the amount of tax that will be paid by the group. So we need to record the tax effect. So what we'll do, we'll debit deferred tax liability by 30% of the depreciation adjustment that we made. So this is $6,000. And we will credit income tax expense by $6,000. So effectively what we're doing is, because we're increasing our expense in this journal here, we're going to be reducing our profits, which means we'll have to pay less tax. So what we're doing here is we're reducing our income tax expense and we're reducing the amount of tax that we will actually defer to the future. This is because if you think about it, before we actually make any depreciation adjustments, the carrying amount for the group is $200,000. The carrying amount for the subsidiary is $100,000. So as I've said before, if we were to sell this equipment, there'd be a gain of $100,000. And so the tax on that would be $30,000. However, after we record our first depreciation expense, the subsidiary will have a carrying value of $80,000 for their equipment, and the group will have a carrying value of $160,000. So if we were to sell the equipment after that first year of depreciation, the gain would only be $80,000. And so if you take the 30% of $80,000, it is only $24,000 that would be payable in tax. So you can see here we credited the deferred tax liability of $30,000 when the difference was $100,000, but because after this first year of depreciation, the difference is only $80,000, we need to reduce the amount of tax liability by $6,000, because if we were to sell it at this point in time, we'd only be paying $24,000 tax, not $30,000 tax. Okay, so that was for 2016. So now we're going to look at 2017. So the first two entries are exactly the same. We want to get rid of that accumulated depreciation and credit equipment to reduce its value. We also want to revalue the equipment here. So it's just the depreciation expense that we need to be careful with. So we'll still need to debit the depreciation expense for $20,000, right, to recognize this year's depreciation. But we still need to recognize last year's depreciation as well. But because expenses are close to retained earnings at the end of the year, we need to make the adjustment to the opening balance of retained earnings when we're recognizing last year's depreciation. And so then we want to credit accumulated depreciation to recognize the total amount over the 2 years. So that's $40,000. So we also need to recognize the tax effects for this. So we will need to debit our DTL by $12,000, right? And that's because we now have $40,000 of accumulated depreciation. And so we need to be reducing our DTL by 30% of that $40,000. So that comes to $12,000. We need to be careful here as well. So we'll credit retained earnings, the opening balance, because the tax expense that we credited last year has been closed to retained earnings as well. So we'll need to credit the opening balance to make that adjustment for last year's reduction in tax expense by $6,000. And so this year's reduction in tax expense we'll recognize in income tax expense account because it's for this year. And so we need to reduce that expense by $6,000 as well. And that balances our journal. So that's all revaluing. I just want to do an explanation of why we actually need to eliminate BCVR. Okay, so we know that our investment line item represents the fair value of the net assets of the subsidiary when we acquired it. So because we add the fair value of the net assets of the subsidiary to the parent assets for the consolidated balance sheet, we know that's why we eliminate the $100 of investment assets. Then obviously we move the subsidiary's assets over. But in this process of compiling the consolidated balance sheet, we also have the fair value adjustments to the assets, all right? And because we're increasing the fair value of the assets, we're also increasing our equity, all right? But you see, when I have moved this fair value adjustment over, it takes our total assets on the consolidated balance sheet to $200, which is offset by the original $200 of equity. Because that investment asset represents the fair value of the net assets. So it is already offset by equity that takes into account the fact that the value of the machine, in this example, needs to be increased. So when we credit the BCVR, we're actually making changes to the equity which aren't required, because the equity already reflects the fact that the machine has been adjusted to the fair value. So this is why that we actually eliminate the BCVR. So we debit the BCVR in the elimination entry, and so that would remove it from this equity, so that the total assets of $200 would match the $200 of original equity of the parent company. So I hope the video was useful.